What's going on? Oh, let me turn down my volume here. What's up, everyone? What's up, my intimate close friends that show up on time for it? Today's time for another Friday live stream. There's a lot to learn from this last week, myself included. I was going to talk about crypto to start out with, but I got to talk about the elephant on my back, and that is this market right here. Man, this is a great learning experience. I was describing this to somebody today, what went on this week in this trade and what it meant to me. And let's just do a little backtrack and take a look at this is the S&P futures. A lot of people look at the SPY, but I mean, they operate pretty much the same way. Take us back to last Friday. Now, last Friday was September the 2nd. We're coming into September. And let's see, September stock market performance. So it's commonly known statistically that September has averaged a 0.5% decline in the month of September. Now that's on average. Doesn't mean it's going to happen this month. It doesn't mean it's going to happen any month, but that is the statistical seasonality for the month. And you can go into the month knowing that. It doesn't mean it's going to necessarily happen, but you can have that sentiment going in. And independent of that statistic, on Friday of last week, now unfortunately on Thinkorswim we can't jump back to the exact moment, but we had a jobs report, which was the big economic news everyone's looking for, because if jobs are good, that means that the Fed may cut some of its tapering. So that's the story around it. So if you guys, well, I know the guys that are watching right now, you guys know that I trade very consistently these sort of volatility spikes right here. And by the way, if you're now just kind of streaming in either on TradingView or YouTube, feel free to ask questions. I'll get to them when I can, and I'll plug the rest later. But I got to get this off my chest. So this was the setup right here. And what basically happens on this 30-minute bar, this is right here at 8:30. This is an hour before the market opens. Every time a jobs report comes out on a Friday, I'm not sure which day of the month it is, but it's always at 8:30. And so you kind of want to be in your seat watching it when it happens. We had this spike up. This spike on the S&P, the futures, because it's before market. This was actually an all-time high. Let me clean this up a little bit. So this was actually an all-time high that it made on that jobs report number. And it was also a spike. Now, what I love about the spikes is that you see where price wanted to go. And if you think about this in terms of being a breakout trader, then a lot of people were queuing off of the last all-time highs, which was around here and here. And so what they're typically going to do is once you just break that last high, that's a breakout. And so you're going to take a breakout. But what happens when a breakout fails? And that's exactly what happened within this 30-minute bar. Price came up here to spike, and then it closed back down here. Well, that's where I want to capture that fear. The fear that people have of loss. And that's what starts to dominate people's thinking and trading when they get into a trade that's going against them. And so that's what you can see by looking at the price action of this spike right here. People got into it, came back down, and oh no, now they've got to get out. And so you want to be in on that, oh no, I got to get out, because that's where some big gains can happen. So where the trade set up for me was right when that 30-minute bar closed. And you had to do it in futures because the SPY wasn't open yet. But I like futures actually a lot better. I really do, because you don't have to worry about theta. So right about there, if you started out, boom, where that bar closed, you were able to capture it. Now, you know where your stop needs to be. You know where your risk needs to be. It needs to be just right above that high. And that's the beauty of it, because you know where price wanted to go. And if it goes beyond that, it's very likely just going to continue, because that's where price was traded and stopped. So that's all you need to give it. And so if you just gave it a stop like that, you would have gone into the weekend without it getting to a meaningful target. And so it takes a lot to go into a 3-day weekend, the Labor Day weekend, with a short position on. I mean, that's 3 days. A lot can happen in 3 days. Anything can happen in 3 days. Earthquake, terrorist attack, I don't know, president resigning for health reasons, whatever reason. But, anything can happen in that 3 days, and you just don't have anything to do about it. So it takes a lot of courage to stick around with it. And on September the 6th, Monday, I even held on to it because, again, all you need is for your stop to be just above that level. And even though Monday was a pretty bullish day and made a high, it didn't make a new high. It didn't stop out the trade. If it did, I would have been okay with it. But I like these setups. This is what I trade consistently. I was comfortable and confident in this setup. And so as it goes forward into some more price action early in the morning of the September 7th. It started breaking down. And at this point, I happened to watch this very good 2-hour speech by a guy, I guess he goes by Tom the Trader, talking about trading psychology. And one of the TLDR of it basically is you need to add to winners, or you should add to winners, or better yet, he adds to winners. And when most people are taking profits too early, that's actually when you should be, considering, I want to be more ambitious, because oftentimes fear basically dominates a lot of trading decisions. The fear of loss is what gets people out too early when they're up, because they don't want to give it back. That's the operative emotion that's going on when people take profits too early. Now, there's nothing wrong with taking profits. In fact, they say you'll never go broke taking profits, but you're never going to make a big win. And a lot of times people hold on to losers. I mean, think about how many times, if you've been trading, you've held on to a loser way too long. And you most of the time always regret it because it doesn't come back. Things tend to trend. And if it's trending against you, it could continue and it just gets worse and worse. But the opposite is true. If you're in a position going your way, it can just keep going. So that's what you want to try to put yourself in the position of being. Just be there. Just be there at that opportunity and let it go. So I was trying to level up as a trader. And so I'm in this position that it's going my way. And I get another setup. I get a breakout setup. Now, breakouts are something that I started trading almost a decade ago. I really liked them when I started because they can be a high probability setup. But the problem with breakouts are they're high risk. Remember, with risk and probability, it's a double-edged sword. If you're going to take more risk, you might have a higher probability of success. Whereas if you take small risk, you're going to get stopped out a lot. It's lower probability of success. That's the balance. But I had some profit to play with on the winning trade, so I wanted to look for a way to add. So I saw a breakout setup happen on the 2-hour. What I've been doing is I've always looked for Ichimoku cloud breakouts. So let's put Ichimoku on here. And we don't need the spikes for right now. So basically in here, we come down, and now on the 2-hour, which is, remember, I started the trade on the 30-minute. As time goes along, we can graduate it to the higher time frame. So now I'm looking at the 2-hour. And what I look for on Ichimoku breakouts is I look for price to get below the cloud at the same time momentum is. And so right around here, when we broke this last low, that was a great breakout entry. Because let's imagine that we can't see all this right now. It's breaking down, going down. I'm in it from up here, and now I'm looking to get into it. Now, the problem with a breakout is that you have to give it enough berth. You have to give it enough width to go, because price can oftentimes snap back. And so what you really have to do in a trade like this is you have to be comfortable giving a very wide stop. And so you really have to look for maybe even sometimes like a 1-to-1. Now, what I was looking for here, ultimately, was a full 50% retracement, which I love. You guys know if you watch, from the all-time high to the low that we made in August. And that would have put the futures at about 4452, also about 445 on the SPY. And so if I chart out a trade based on that with the target down here, and we need to give it some about that much there, it almost puts my stop right above the high, which is actually pretty comfortable. And so now at this point, I can have my second entry into this trade. Good stuff. If it goes, it'll work out really, really well. I will have successfully added to a winner. Normally, what I do is I take about most of my position off, 75% or more, at a target and let the winner run. That's what I've always done in the past. But this lets me scale into the position. This is what I wanted to do in this trade. But Thursday, we have this situation right here. Now remember, I've got both of these positions on. And so while this one is still in profit, the one I started on last Friday, it's now come back up to about half the profit it was. There's that fear kicking in, the fear of giving up what the market had already given me. And I've got this now new position that's at about half risk coming back. And so the profit on the existing trade is down, the loss on the other trade is up. And so what you're getting is that inversion of the P&L on this position. It starts to go negative up to this point right here. And remember, it's double the size that it was. The smart thing to do, and I'm going to talk about this later when I look at some reviews of trades for the last couple of weeks, it's just general trading. The smart thing to do in trading is you keep the losses small. So I closed it. Well, you know what happened if you were watching today. That was just one of those stupid rallies that happens in breakouts. I want to trade breakouts, but man, they are difficult. They are very, very difficult to trade because you have to give it so much more risk. That's just the nature of them. But man, I was talking to somebody about this today or yesterday, and they asked me, is your pain from FOMO or is it the loss? Well, what really bugs me now is not the money, believe it or not. I know trading is about money, but I was listening to my girlfriend play her new piano that she just bought, and she hasn't played in years. She's amazing at it. She hasn't played in years, but she sat down and she started playing some Chopin, which is very difficult if you haven't listened to Chopin. But she would make some mistakes, of course. She hasn't played in like years. But it's amazing that she can play off sheet music and not miss the beat. What I wanted to do with this trade, starting Friday with a fundamental sentiment, a statistical seasonal sentiment, a trading setup around a news event, then going into another technical setup to add to a winning position. If it would have gone smoothly, and you can't ask the market to do that, this to me would have been like music. That's really how I see it. I would like to sit here today on this live stream and tell you that's where I got in, that's where I got in the second time, and then right here at the close after a week, I took profit at this level that I thought it was going to get to. That's the goal that I want to get to. It's not, I don't even know how much this would have been, but it would have been about drawing this up and printing it out and putting it on my wall as this was September 2021's SP 500 trade. It was a beautifully crafted piece of art to play it out. But this happened the way it did. Oh well, on to the next one. Actually, there was even another opportunity here at the open this morning. And this is why having that emotional fortitude really comes into play. If I would have not been having such a damn pity party about it, remember I love the 50% retracements. You had that high that messed me up down to the low, and right here at the open. Wow, amazing. You even have that level being supported here. So even if I was being all mopey and everything, all I had to do is wake up this morning with fresh mental clarity, see this spike, short it right here in the consolidation or on the break, and it would have been another one. So what really messed me up here was my lack of faith in breakouts. I know that you have to give it a big risk. I know that you have to give it a good wide stop to accommodate these kind of little swings. Just had to really see it happen. Now I have. So now I'm not going to let something like this get away from me. So that is the SPY trade for this week. That's me being authentic about it. So, yep. Audio bitrate problem. Is that still an issue? See that? I don't know what timing that was. How was the audio? Is it still chopping around? Sounds like I'm behind a fan. Okay. Let's see if I can address this a little bit. Test, test, test. Okay. How about now? Actually, the people on TradingView say the audio is fine. TradingView, how's the audio for you guys? Okay. YouTube, how's the audio? Still a bit quirky. Hold on a second. Test, test. So let's do a little test. Send me, yeah, that's going to get an echo. Test, test. So let's do a little test. Send me, yeah, that's going to get an echo. Yeah, okay. You know, that was actually in my stream from last week, and I thought that was my microphone. I'm thinking that it has something to do with the TradingView to YouTube conversion, because the TradingView thing, people think that it's fine. Sorry, YouTube. Yeah, last stream. Yeah, I know. You know, I thought it was just my mic on my equipment, but I think it's actually this setup on here. So my apologies on the YouTubes. I'm going to do some testing. I noticed that they just set up on TradingView for being able to use OBS. They hadn't had that until about this week. So bear with me today, and I'm going to fix it for next week, I promise. So the show must go on. A question about that spike. Well, you can be yours for the low price of $89 a month if you go. No, I don't do that. You really just got to ask me. Just send me a message on TradingView. Let me go ahead and plug. I have a Discord, and I don't charge people for it. It's just for traders to talk about trading on a daily basis. It's where I post my trades that I take, and we have a lot of smart people in there. There's some rocking emojis, and there's some talking about DeFi degeneracy, but we keep that in their own little channel. But no, I don't run a paid service. I don't charge people for it. I want people to be better traders. That's why I share my experiences. I mean, I've been doing this for about a decade now. I want people to maybe learn from my mistakes and hopefully avoid their own. So, yeah, go to the links, join us, and hope to see you there. Bougie, am I a full-time trader? Yes. No, I have not used a prop firm. Do you want me to give you my opinion about prop firms? I've never traded for one, but I've looked into it. What I know about prop firms is I'm not going to say that they're bad or good. Prop firms are they are education companies that will actually stake you money. What happens is, let's say that you go to one of them, they're going to have you put down a deposit of your money, $5,000, $50,000, whatever, and then they're going to give you $100,000, $500,000 to trade with. So they're basically giving you a lot of buying power, but you have to deposit money. So essentially, they're giving you leverage that you can't get trading stocks normally. Like if you trade stocks normally, you only get to trade 1.5% leverage essentially, and so you can't buy much stock, but you can with their money. But if let's say that you put in $50,000 and they give you $500 to trade with, well, if you lose 10% of your account, you lose 50 grand, they're going to cut you off, because essentially what you've done is you've lost your money, and they're not going to actually take risk on you. They're going to give you the leverage, but when you get to a certain point of losing money, they're going to cut you off because they're not actually taking risk on you. Meanwhile, typically, and this is probably varies from prop firm to prop firm, you are paying for the initiation fees, the classes, the mentoring. So yes, you can make money with what they teach you, but you're paying for it, just like an education firm. And you can make money with their money, and they're going to profit share with you. So yeah, it can work, but at the end of the day, they make their money off selling education, and the few, because let's face it, not everybody succeeds, the few people that do actually make it, but at the end of the day, they take no risk. So I'm not saying it's a bad thing. I'm not saying it's not an opportunity for people, but that's just their business model. So just understand, when you see prop firms advertising what they're doing, that is how they work. So hope that helps you make a decision. If people don't have access to capital, it can be a very good thing for them. But you have to understand that there's nothing really special or unique. I mean, they're still teaching you the same stuff, moving averages, selling credit spreads, and that sort of thing. One of the more popular ones is SMB Capital. I know they're very prominent on YouTube. I watch a lot of their stuff. They have really good deep dives into strategies and having traders talk about what they've done. But they are a prop firm, and so I'm not sure what their structure is, but they release really good stuff. They're real traders, and so I'm not going to knock what they're doing, but that's just the business model. FTMO, they have a trial for their $100,000 account, and the deposit for so if the deposit is $2K, so they're giving you 50-to-1 leverage. That's what they're doing, and if you lose the 2K, or if you go down 2K, they're going to cut you off. They're not going to lose money on you, because heard that's an 80% take. You mean you get to take 80% of your profits? Sure, if you make them. If you make 80% profits, that's great. But like I said, if you lose that $2 grand that you deposited, they're not going to let you lose more. They're not going to lose money on you, because I mean, look, most people fail at trading. It's just a reality. So, yeah. All right, let's talk about crypto. I know that's what a lot of people want to see. So, yeah, you're welcome. Crypto. Let's start with Ethereum. Now, last week, actually, I posted a video to Discord, a little clip from the live stream. If you go back and watch it, I don't remember later on when I'm talking about Ethereum, I'm not going to sit here and claim I called the top, but it does validate what I talked about in there for looking for resistances. The reason I'm not going to claim it is because I didn't trade that top. So I'm not going to sit here and I'm very averse to people coming in after the fact and saying like, oh, look what I did, and you didn't actually do it. No, but this can be a learning experience. So what we talked about last week, we were about right here. And this was Friday of last week because this bar had not closed yet. And what you want to see when price starts to retest highs, and I'll rehash what I said about that. So here's the all-time high of Ethereum, 43.72 roundabout. If you're trying to, let's say you bought it somewhere in here as it's going up, or you're holding and you're looking for a place to maybe shave some off, or if you're trying to listen to that guy, you're going to hold it on forever, that's fine. But if you're a trader, you're looking at levels and maybe a breakout level you want to take as well. But you don't always know that you're going to get back up to that level, because sometimes it can miss. And one of the most annoying things is when it misses by like a penny. For instance, the low, let's just say the low here was 171.20, 17.17.20, and the low here was 17.21. So 17.17.20, 17.21, about $3 difference. It looks about the same, but if you had your buy order right at that low, you would have missed about $3. So we can't really use the actual low proper. So the question is, what else do we use? Well, some people use a thing called secondary pivots. I studied that, but what I've looked at and really come to believe is what I call a reaction level. It's my word for it, and it's just explanatory. Maybe I'll put in a chapter of a book one day. But let's go back to the price action around this high and see what I mean by that. So when this high gets made, people sell it off. You don't know the high is going to happen, but you can know when you get a pretty significant reaction. Now, if you want a way to codify it, I got the red line here on my retracement level indicator. It's the 9-period median, or the Ichimoku Tenkan-sen. If you get a close below that level, that's going to be your first sign of weakness on a trend. First sign. Doesn't mean it's going to end, just your first sign of weakness. Your next sign is the Kijun-sen, the green line. And of course, if you get below the cloud, you're full on bearish. So the first one you're going to look for is there. Now, what is price doing? Price made a high. Price is going to make a low. All right, so let's see what happens. There's a low. All right, now what's it doing? Okay, it's coming off that high. And so down it goes. But do you see this right here, from the high down to this first swing low, followed by the failure right here to make a new high? Now what you've done is you've established this area of price action that I'm going to call a reaction level. And so within this reaction level, let's do a little box around it right here. From that high to the low, now you've got a little segment of meaningful price action that you can cue off of going into the future. And so what do I like to look for in just about everything? 50% retracements. So let's draw that up. From the high up here down to the low right there. Boom. There's the middle of this reaction level. This is where the meat of the trading happened, when people were fighting to make a new high and it failed. Right there in the middle. So if we go into the future, what we do, if we bought it and we were looking for a target, let's slow it down. If we're looking for a target, is we want to, a little faster, come on. We want to see it come back up to that level. So we're in this bull trend right here, and we're looking for it not to get up to the high, but we want it to come up to this level right here. We want it to come up to that reaction level, the midpoint of that reaction level, from the high to that low, right off the high, 50%. And then as long as price holds it, that's holding the resistance. And that ended up being a beautiful thing. So that is how you can use multiple ways. If you're in a position and you're looking for a profit target, like if you're trying to play to the high, let's say that you're a trader, I don't know, a Fibonacci trader, and you're trading like the fourth or the fifth way. And this would be the conservative way to take the profits as you get up to that high. And so it just happened to work in this case. But it works a lot. It really does. And that's what I was talking about in the live stream last Friday, as this bar right here had come up and hadn't quite closed above it. And it's really beautiful to look at when, this is why I really encourage people to be patient when they're doing technical, just simple stuff like bar closes. Looking for candlesticks to close above or below to confirm a support or resistance level. It's very powerful. And this right here, you had that, it was the weekend. The weekend couldn't, it poked his head above it a little bit, but this helps people be patient when you wait for that daily bar to close. And sure enough, it did. And so I really want people to study these types of reaction levels right here. That's what I would encourage you to do. Whenever something makes a big move and has a big high, draw a box around the primary pivot, which is the top, and then the secondary pivot. And then right there, you have the levels that you're going to look for going into the future. And so that's going to be very, very powerful. Very good for finding profit targets. And in this case right here, it told you where we were going to kind of stop or give you an idea. So Bitcoin is another one that I find interesting. Now, this my original thesis for Bitcoin, or my thesis since we had this drop in May, has been that it is going to go down a lot. Not very popular, but as I've explained to people, I've been watching this for a decade now, and this would not be the first, this would not be the second, this would not be the third, this would not be the fourth, this would be the fifth time we had a blow off from a big moon. Now, a lot of people think, oh, the moon's not over, we're going to 300K, and that's fine. But you know what? No matter what price it gets to, Bitcoin's going to have an 85% retracement. It could go to 300K, and that could bring it back down to about 40, 50K. That could happen. That's an 85% retracement from 300K. Or it could be a 85% retracement from the high that it made at 65, which would take it down anywhere between 15K to 12K. I'm not going to say where it's going to happen, but that's what I'm looking for, because that's what crypto does. It just does. So I've been looking for that since this drop, since the momentum was dented. And so what I was looking for was from the all-time high down to this reaction right here at this 47 level. And right here when it hit it, that was what I was looking for. But even though it respected it briefly, it came up, broke above it. More importantly, if you were still looking to get long, where's my arrow? Brush. You could have bought it on the breaking retest. And this is where an example of how a resistance can become support. Again, you have a lot of price action above it, boom, holds it, and then this would have given you a nice little run up to here. Now, there's a lot of speculation for what happened. Obviously, there's a lot of leverage getting liquidated. Bitfinex went down on this. I think some people may have taken some whales might have taken an opportunity to dump it. Whatever the narrative is, I don't know about it ahead of time. I can just look at price. But if you notice right now what we're doing, we close back below it here, and 1, 2, 3 this week we've held below that. So this as resistance was confirmed as support. Now it's back below it. I mean, it could just be a nasty consolidation for a while, but this is the level that Bitcoin is fighting right now. It's the 47. Let's just call it 47K. 47K. And so, if you look back in time, whatever happens in the future, the respect for this level is going to be important. Whether it holds here to go down or if it comes back up above it, retest it to launch up again, this is a key level. Right now it's below it. So that's what the price is telling me. So, any questions about this before I talk about the other fundamental thing? I was going to talk about some actual fundamentals. All right. So that's about price. I watched this YouTube. It was Bloomberg Wealth with Dave Rubenstein right here. It's a very good piece where this boomer talks about crypto. Let me make sure that you guys are going to be able to. Yeah, I think you guys can hear with the sound set up. So let's watch this clip right here, and let's hear what he says. Oh, I'm not getting it because. Oh, hold on. Booga booga boo. Oh, wait. No, it was coming through. I have my sound off. There we go. Sorry, audio issues again. 1 second.
Barrel on average will be a losing proposition.
Okay, what about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price will go down. There's no intrinsic value to any of the cryptocurrencies except that there's a limited amount.
Okay. I'll stop him right there. He's wrong. Well, he's right and he's wrong. I think in a lot of ways, Bitcoin is, or cryptocurrency is, a speculative asset. But to say that it doesn't have intrinsic value, I think he's just an uneducated boomer. He's in his little world. I'm knocking him. I mean, that's fine. It's fine to be old. I'm getting older too, and there's a lot of stuff that young kids do that I don't want to do. But he's failing to understand what cryptocurrency is. But I think, unfortunately, a lot of people that are very bullish on cryptocurrency, are big believers, are also failing to understand what Bitcoin actually is. And this is my opinion, of course. And I've been pretty open about this in live streams and when I've talked. Yes, the demand is what drives up the price of it. But really, we need to talk about what is that intrinsic value? What is he missing? What is the intrinsic value of cryptocurrency that he's not seeing? It is more than just a speculative asset. And he also talks a little bit more about how the scarcity. He actually understands. Actually, let's listen a little bit more. Let me give him a little more credit. Listen to what he says.
Why would you not put a big short of some type on cryptocurrencies? Well, maybe you have, but do you think that's a good short?
Well, when we look for these subprime, the reason why we shorted these subprime inside is because it was asymmetrical. Shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000. It would be wiped out on the short sides.
So that shows that he's actually paying attention. I mean, I actually agree with him there. It's very, very difficult to short something that is mooning. He's coming from the perspective of the bond side. And by the way, this guy is known for shorting the credit default swaps, the housing bubble, everything. He made about cool $15 billion, got a lot of attention for that. But he really hasn't been able to repeat that since. He got lucky. He read it. I won't say that. He read it right. So he's paying attention, and I agree with him. It's really good to have like a fixed risk and then unlimited upside. But if you're trying to short cryptocurrencies that are going, up 1,000%, that's a dangerous proposition. So he's paying attention. He at least understands it. But let's hear one last part where he talks about the scarcity.
While John Paulson is shunning the crypto craze, many of his peers in the industry are wading deeper into it. Earlier this summer, Steve Cohn's Point72 was hiring a head of cryptocurrencies. The firm told investors it would be remiss to ignore a $2 trillion market. Meanwhile, the family office of billionaire George Soros has started trading Bitcoin. Macro trader Paul Tudor Jones has begun investing in crypto, and Dan Loeb says he was doing a, quote, deep dive. Now, the big financial institutions such as Goldman Sachs and Citigroup are getting in on the game. The result? Hundreds of job openings. Binance, the world's largest crypto exchange, is advertising for 370 jobs. Still, is the talent pool deep enough to fill everyone's needs? A single job posting may attract hundreds of applicants, but finding candidates with the right experience can be difficult. So, some firms are lowering their expectations in the hedge fund format. Hedge funds have different types.
Okay, so what he said at some point that I should have noted was that the scarcity is the value that people place on it. It's true. NFTs are an example of that, where they cannot be replicated. I mean, a lot of people say, I don't understand NFT. Well, do you understand baseball cards? There you go. Why do people want to own a piece of paper with printed on it? Why do people want to own a digital copy? Well, it's because it can't be replicated. They can say they own it. It's rare. It has value, whereas they're printing dollars, constantly. But where he messes up on the intrinsic value of cryptocurrency is very simple. The intrinsic value of cryptocurrency is decentralization. It's the distributed network. that's been the fundamental reason for creating it outside of the federal system, the Fed printing money, all the countries printing money the world over. The intrinsic value is in the deregulated nature of it. So it's the decentralized nature and the deregulated nature of it. That is the intrinsic value. And I fear that that is being lost right now. I think the idea of that's being lost on a lot of people too. If it doesn't have intrinsic value, then he's right. Then he's right. It is just a speculative asset. But the intrinsic value is that no one person can control it. It cannot be stopped. It has a fundamental momentum of its own. It has the power to change the world of finance if left to its intrinsic value, which is distributed, decentralized, and deregulated. And as I've said many times on here before, it's under threat. It's been under threat for a long time. It's very regulated now. Pretty much every financial regulatory agency has taken it upon themselves to write their own laws. You know, this week there was the little kerfuffle. Coinbase and the SEC is suing them to stop their lending program, which was a very generous way to save money. It was given like a 4% APY, which, you know, it's not that much, but in a 0% savings account world, it's a lot. And of course, the SEC came in and shut them down, threatened to sue them, even though the SEC is headed by someone that taught cryptocurrency at MIT, which everyone thought would be friendly. And Coinbase is at the forefront of trying to be compliant with regulations. But this doesn't actually matter to me because I've always seen Coinbase as the enemy for trying to centralize it anyway. Yeah, so let them fight over it. But it's just another example of how once you get these regulatory agencies in there, the freedom goes away. And that is the intrinsic value. The freedom from not one single person or one single entity being able to control it, whether it's by regulation, whether it's by laws banning people from owning it, like they banned people from owning gold in the 1930s. If you don't think that it can happen here, it has happened. Where, yeah, you can still tuck it away somewhere. You can keep it under your mattress in your treasure. But if you get caught, you go to jail. That can happen. But it doesn't mean that it's going to stop it. And so you have to understand that the intrinsic value of cryptocurrency is the deregulated nature. And I hope that a lot of people that are getting into it now are very passionate about it, understand that, believe it, and act accordingly. So that's my little soapbox for that. Any other question? Yeah, mining work is value. Tatami, are you on my Discord? Did you see the YouTube presentation a friend of mine gave about that very concept? Hold on, let me find it. It's a very good point. Let's see, where is he? Yeah, he's talked a lot about stuff. Here we go. So he gave a talk on this right here, which I'll link in the chat. Of course, yeah, let's see. Great. Okay. So he gave a great talk on this very concept of proof of work. For instance, I think a comparison was made to Stradivarius violins. I think that's his comparison, and how Stradivarius violins are rare and high quality, but it's also because I think in theory, I'm not sure if this is true or not. Maybe I'm just talking out my ass, but I think that part of it is the wood that they were made out of, these violins were made out of, was very high quality because of the weather that happened in the 1600s. It was, I think, particularly dry, so the trees, rings were very compact. It was very, very tightly packed wood. And so because of that specific century of trees made by really very good, high-quality people, that is why they have so much value, because a lot of special conditions went into the creation of it that cannot be replicated. You can't replicate that wood. You just can't. You can't replicate the skill, and that means that you can't just go and create a blockchain, a ledger that goes all the way back to 2010. You just can't do it. There's a lot of energy, there's a lot of electricity, a lot of power that went into mining and producing it that is inside that. So yes, that mining power is the value. Yes, I do believe that theory about what gives it intrinsic value. Now, don't tell that to, the greens that, are worried about the carbon footprint of cryptocurrency. Yeah. So all right. I promised last week that I was going to look at some trade reviews, and and it's not just for, just to say, here's what I did for my sake, but I want people to understand some of the value in cutting losses. Now, we all hear that and stuff, but I mean, I deal with this on a daily basis. And at the beginning of the live stream, I was talking about the SPY trade this week and why I closed it, because it was turning into a loss. I'd rather have a small loss than a big loss, because look, we're in, no matter how you slice it, a bull market in stocks. Okay. Today's dip, minor in the grand scheme of things, going back to, wow. Yeah. So you got to be careful when you short something, because your risk can be unlimited. So you unfortunately have to cut losers. And so I just want to look at a couple of trades from the last few weeks. So let's look at a good trade. Let's start on a high note. So this is one that has actually come back, but the money was already made. Where this happened was right around here. Now, you can't see it on TradingView because the data is not there, but there was a spike that was at a 50% retracement level. And then, just like I've said before, this one actually got up to the high proper, but from this level right here, basically, boom, I was able to get a 3-to-1 on the initial position. And you really didn't need to stop much below that 50% retracements. Now, of course, this is where I use my standard strategy, which works for me, which is I take off most of my position and let the rest ride. It's now back down to support, so I may have to close out the remainder on Monday. Oh well, I still made profit on it. But this is just another example of how, taking profits can sometimes be the best case scenario. So this is one example of where two things. One, you don't need to give it much risk, and two, you got to take some profits. It happens a lot. WBA, Walgreens. This is one where I think if you go all the way out right here, this one started from October 20 up to here. Here's the retracement level that it hit. Did not catch it here. Where it set up was what I've been starting to look for, which is I call a 50 in a 50, where you hit a major 50% retracement, and then what you look for is that reaction level. Remember that reaction level? And so from boom to boom right here, it set up a opportunity right here. So you take a position and you can have your stop just below that last low. If you want to be really tight, you can do this. But again, it goes back to that. If you take small losses, you're going to have a lot of losers. But you can get an initial 3-to-1 from here. But you can also, if you want to, play it all the way back up to something like this. You can get a 3-to-1 all the way down to there. And so that's going as well. And so what you got to understand by looking at these two good examples. Let's look at another good example in strategy. LH, and of course, I'm going to get to my losers here, but just wait for it. This one, where did we start this guy? Was it back? Let's see. Let me start on the daily. It's going to be easier to see. Was it? No, it's not March. It was this year. Hold on. That doesn't go back. 258. Yeah. Okay. Yeah. All right. Right around the bottom of this consolidation right here. Okay, yeah, that 50% right there. And so, trading view data, did we have a spike there? Show me a spike. No, not on trading view data, but it's in this little consolidation right here at a 50% level, right where you would have had the past high to back it up. Yeah, this price action right here, setting up, boom. Now, I've shown you these good trades. Now, the EQ, with the exception of the EQR, but this is a really good example of something that just goes. This is what I want to see in trading. I mean, I want to see stuff like this. Another thing we talked about this week was Costco. Costco is something I've been in for. I got into it back in March on this dip because it was, kind of scared me a little bit. It was in the long term, but pulled back to the dip right here. And then when it consolidated and I started doing a lot of shopping, I got a smoker. I don't know. There's a meme out there that once you turn 35, you either have to start smoking meat or get into World War II history. Well, I've already been into World War II history all my life, so that was just the next step, was to get a smoker. So I've been going to get a lot of meat, and man, you cannot get out of Costco without spending $200. And so I figured, man, I need to own more of this company. And so within this consolidation right here, you can add to the position, and really your stop just needs to be below it right there. And so that's all the risk you need. If it breaks below there and goes down, get out. Because what you want to happen on trades like this, whatever you get in, you want it to do this. Now, yes, you want something to go in your direction, but it's not going to happen all the time. And we know this. We accept this. But think about these. This is what a really good trade looks like. If it doesn't do this, do you really want it? Is it really worth hanging on to something that's just dying on the vine? Losers. So BMC I talked about, where I got into it right around here, and it didn't quite get up to my target. You remember, sometimes that reaction level doesn't hit. Boom to boom, barely missed it. That was my target, it missed it. And so when it got back down to my entry, close it out. Didn't get there. Oh well. Some people would diamond hand it. I don't like the diamond hands. I don't like that meme at all, because it just keeps going. I mean, what are you really going to do? The math is such as this. If you're doing a 3-to-1, let's see, where was it up to here? And let's just use 100 as your dollar risk. Okay, so you're risking $100. You don't get it. So if you hold on to this, what are you actually doing to your risk? Well, there's your first 100. There's your second 100. Now you're 2 times the risk you plan on doing. Now you're down 300. Now you're down 400. You've lost 4 times what you intended to risk. That's 4 losing trades you could have taken in something that has a chance to go crazy. You wasted 4 losing trades trying to make this one work, and it just didn't want to work for you. Things just don't come back. You got to internalize it, even if it hurts. Even if you run into what I ran into with the SPY trade, and it started going against me, and I closed it out, and I missed a great trade. More often than not, it really hurts you. It really does. Where are some of the others? Lockheed Martin was one that I was in right here. You know why I'm in it. If you follow me, you know that I'm in it because of this nice, pretty 50% retracement. You know, the Afghanistan pullout was going on at that time, and so it kind of had a fundamental, I don't care, but that kind of had a fundamental story to it. And, you know, it got down to, it breached it here. This was where's the spike? The spike was right here. Exactly what I want to see. At a 50% level, price hesitating, spiking, coming back up, boom, boom. Beautiful. Would have been beautiful. Would have been beautiful. But it wasn't. It came down, and gave me an alert, and I got out some here right. I took a small loss. But then as the days went on, of course, I'm going to look at it again. I'm going to be like, was following my rules the right thing to do? So how much risk do we have on this? So from here down to here, that's one risk. So that's two risk. That's 3 trades. And then that's 4 trades, or 3.5. You can't win holding on to it, because let's just say that I had my next trade was a winner. I needed that winner just to make up for this one loser. You can't make money that way. You need your winners to make up for a lot of your losers, because you're going to lose more than you're going to win taking small risk trades. It's just a fact of probability. You just can't let things try to come back. Another one, TJ Maxx. This was, where was this one? This was here. There's that spike I love to see. Again, would have been great at a 50% level. I also kind of like the post earnings, play. It just didn't work. It's okay. But if I had held on to it, where would I be? Let's see. It's 1, 2, 3, 4. And what do you do at this point when you're down 4 times your risk? What do you do? It gets even harder, because you're already in no man's land. You don't know what you're doing. You're outside of your strategy. You have no rules at this point. 5, 6 times risk. That's 3 winning trades if you're doing 3-to-1s. That's 2 full winning trades that you got to do to make up for this one loss you were trying to get back. You get a little pullback here, but you're still only down 4 times your loss. What are you going to do? Are you going to? No, you're just going to get burned. Now you're going into 7 times your risk. It doesn't come back. If it doesn't go the way you want it to very quickly, I'm not going to say it's a hard and fast that you have to give it time. I mean, you don't want to give up something at support, but you can't let these kind of losses run. It just doesn't make sense mathematically in your trading. It just doesn't. So